Hello traders. In this video, I will talk about how to properly use support and resistance levels to make trades, to find good entry points, and for other trading tasks. So, let's first talk simply about what support and resistance levels are. These are price points at which bounces either downward or upward often occur. If we're talking about a support level, it would look something like what I have standing dotted line. This is the level from which the chart has bounced upwards several times before. This indicates that at this price, there is a volume of supply, there are pending bids to buy. And once the price gets to that level, it becomes very favorable for someone to buy. And at that point, deals are automatically made and the price of that level goes up. Conversely, a resistance level is a price from which price has often previously bounced downward on history. This tells us that at this price, someone is already very profitable to sell to. And there are pending sell orders here, and as soon as the price reaches this point, the orders are automatically triggered. And at this point, there are more bears than bulls in the market, and the price starts to pop down. It is very important for a trader to learn how to properly find and set support and resistance levels, even if this is not your primary strategy. Because support and resistance levels, just like trading channels, are good confirmation signals for your strategies or can serve as separate sources of information. So in this video, I want to tell you the 4 rules of how to chart support and resistance levels. So the first rule is multiple rebounds. The first and most important thing when setting a resistance level or a support level is that the price has bounced from it often before by history. Let's say if we're in this part of the chart, we can see from history that here from this price of 84,500 on Bitcoin plus minus $500. Price bounces back up to this several times. That's where there was a little bit of a breakdown. In this moment, 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 at least 7 times before this price has bounced down from this level. So we can draw a horizontal line here, and the next time the price approaches it, we will make trades in the opposite direction. Here, for example, one time it came up, and here after the big hairpin went a bounce back down. And here's another point. When the price has approached the resistance level again, and clearly at the resistance level we see a reversal. And the more times in the previous period the price bounces from this level, the stronger the support or resistance level is considered to be. For example, the support level, as I have shown, we can put in from here. Yes, we can see that we have one bounce, another bounce, then a third bounce here, and then a fourth bounce here. But it's not as much as the previous case. The fewer touches there have been, the fewer times the level has sustained a trend in the past period, the less strong it is considered to be. As you can see, there was a breakdown of this level next. The next rule of thumb is sharp rebounds. We can put out support and resistance levels, not necessarily because we've had a lot of touches before, but also, for example, in this case, if we had some price movement, and here we got a very sharp candle in this particular moment. This means that from this price, we can set resistance and further consider it as a resistance level. As you can see, 1, 2, 3, at least this level was triggered later on and kept the price from rising. The third rule is to use support and resistance zones rather than levels. In the real market, things are not like they are in a trading textbook. You don't have any particular clear line that the price will bounce off of in a textbook perfect way. Usually the zones of increased demand and increased supply are not just one price, but some range of prices. For example, from $95,000 to $95,500. There are bids in this range, and the price can bounce either from here, from the middle of the range, or from the lower part of it, or from its upper boundary. And if you use only single levels, instead of resistance zones, as shown in the previous examples, you might not get some signals or get a breakout on your level and so on. It is important to use exactly the support and resistance zones. For example, even in the first example, we could set the level, not specifically here, but we could make a level like this. and it would more accurately show the actual resistance range, because this is the point where we had a puncture, and this is the point where we had the price going out of line. And even at this point, the chart bounced not from the level, but a little further away. Therefore, it is correct to use resistance and support zones, lines that are not far from each other, which for you mean that in this zone, plus or minus a few points, there will be a rebound. And the fourth rule is that support and resistance levels very often become mirror levels. In this case, the resistance zone. What does mirror level mean? This means that if a level has held price well in the past, for example, here we see a clear resistance zone. Here we have one bounce down, a second bounce down, a third bounce down. This resistance has worked a few times. We can put it up at these levels. And if we have a breakdown of these prices, then this resistance is no longer relevant because it has already been broken. It may become a support in the future. As you can see, if we scroll further down the chart, we see that the same lines have become support. We see one bounce up, a second bounce up, and so on. Why is this happening? Because often support and resistance levels are at some key price values or at some levels. For example, 100,000 on Bitcoin or 50,000 on Bitcoin are some round levels that both sellers and buyers become a reference point depending on where the price is. And so, if your marked support and resistance zone has already been broken, don't be in a hurry to remove those lines. It is quite possible that for the future chart movement, these same lines will become support and vice versa. Here are 4 rules like these that will give you a much stronger improvement in the quality of how you use resistance support levels in your trading. Be sure to apply them in your strategies, and be sure, even if you trade on technical indicators and not on levels, to add additional levels to the chart. This will help you more effectively choose good entries and miss false signals. Share in the comments what rules you already use and what was new for you, and see you in the new videos.